John A.G. here with a quick note for newcomers joining today, because imitation channels are spreading confusion with copied thumbnails, styles, and misleading offers across platforms. There are channels copying this exact format, using similar thumbnails and presentation styles, attempting to sell courses, memberships, and signal groups to unsuspecting viewers seeking guidance. That is not this channel, and it never has been, because our mission is transparency, independent verification, and data-driven analysis, rather than monetizing fear or selling exclusive access. This channel sells nothing, has never sold anything, and will never sell anything, because information should remain accessible, verifiable, and free from conflicts of interest or hidden incentives. What you receive here is raw data, primary sources, and structured analysis that you can independently verify, ensuring your decisions rely on evidence rather than persuasion or marketing tactics. If you are actually here and not a bot or scraper, drop currency archive in the comments so I know real people are engaging with this information, or drop a question you want analyzed, because I read everything, including every comment and message, prioritizing topics that matter most to this community of critical thinkers. Sunday evening before a Monday open is when signals matter most, because liquidity shifts, positioning resets, and institutional strategies often finalize before global markets resume trading activity. What I am about to walk you through tonight is, without exaggeration, one of the most structurally significant setups I have ever covered on this channel. Silver closed Friday at approximately $87.73 per troy ounce, marking a 6% daily gain and extraordinary weekly momentum. It rose 18% on the week and 25% year to date, reflecting forces far beyond simple speculation or short-term retail trading enthusiasm. The story behind that number is deeply layered and interconnected across geopolitics, physical supply constraints, paper market mechanics, and institutional positioning strategies unfolding simultaneously worldwide. Financial media has no coherent framework to cover this complexity, so they avoid it entirely, which is precisely why this channel exists, to fill that analytical void. Tonight, we will map the coming delivery crisis into February 27th and explain why futures obligations may exceed available physical silver inventories within the exchange system. We will examine the Supreme Court ruling striking down prior tariffs and the immediate replacement tariffs, clarifying why precious metals exemptions alter supply flows into United States markets. We will analyze China's strategic silver lockdown, India's record absorption of global supply, and the physical premium explosion that recently exceeded 50% in wholesale markets. We will also connect the macroeconomic backdrop tying these developments together, including currency weakness, bond yields, geopolitical tensions, and the accelerating shift toward strategic resource nationalism worldwide. And I will present the honest bear case as well, because intellectual honesty distinguishes education from hype, ensuring viewers understand risks alongside bullish structural arguments. Before examining forward projections, you must understand context, because silver's behavior over the past 4 weeks has no precedent in modern commodity market history. Silver opened 2026 near $70 per ounce and moved parabolically through January, driven by physical demand, speculative momentum, and gold's breakout above $5,000. On January 29th, silver touched $121.67 per ounce, obliterating the 1980 Hunt Brothers record that stood for 45 years. What followed was equally historic in the opposite direction, as silver collapsed 47% within roughly 30 hours, falling from peak levels to approximately $64. The CME hiked margin requirements to 15%. A hawkish Federal Reserve nomination emerged, and officials attributed forced liquidation to speculative Chinese trading activity. 3 simultaneous forces hit the market at once, triggering cascading liquidations and forced selling that continued into early February, ultimately bottoming near $63.85. A second sharp decline on February 12th and 13th produced another double-digit drop, marking the third worst daily decline in 6 years across silver markets. Yet the crash narrative misses a crucial fact. Every sell-off was met with aggressive physical buying, signaling underlying demand remained strong despite extreme paper market volatility. The recovery from $63.85 to this week's $87.73 represents a 37% rebound in 17 days, a rare V-shaped recovery. Technical indicators now flash strong buy signals across multiple timeframes, confirming momentum driven by physical demand and short covering rather than leveraged speculative inflows. Critical resistance near $84.91 broke cleanly, establishing new support, while next targets sit near 92 and 100 with prior highs looming above. Managed money net long positions remain extremely low, showing speculative traders have not re-entered, meaning the recent rally was driven primarily by physical demand and short covering. This context explains why the next 4 days could become the most important period in modern silver market history, with delivery obligations colliding against shrinking registered inventories. The primary exchange for precious metals futures allows contracts to settle in cash or physical delivery, though historically most contracts roll forward rather than demanding metal. Right now, delivery is becoming the rule rather than the exception, with registered silver inventories falling sharply as withdrawals accelerate and delivery percentages approach unprecedented levels. Registered silver fell to roughly 88 million ounces, after a single-day withdrawal exceeding 3 million ounces, continuing a multi-year inventory collapse exceeding 80%. Since October 2025 alone, registered inventory dropped 38%, while January withdrawals removed over 33 million ounces in just 7 days. January deliveries totaled 49 million ounces, more than 7 times the prior year, while February delivery rates approached 98% of eligible contracts. March delivery first notice day is February 27th, with open interest representing 429 million ounces against only 89 million ounces registered supply. If even 1/4 of contracts demand delivery, required metal exceeds total registered inventory, creating a potential supply squeeze within the exchange settlement mechanism. Futures already trade in backwardation, where spot exceeds future prices, signaling immediate demand for physical metal and willingness to pay premiums rather than wait for delivery. Eligible inventory exists, but belongs to specific owners and cannot be forced into delivery, highlighting the distinction between stored metal and deliverable supply. This arithmetic raises a simple question. What happens if delivery demand exceeds available metal, forcing cash settlement or emergency sourcing by bullion banks? Historically, banks have provided delivery notices or cash settlements, but each intervention strains credibility and increases pressure on short positions lacking physical metal. This is public data published daily, and anyone verifying primary sources understands why February 27th represents more than another routine calendar date. Meanwhile, the Supreme Court ruled sweeping tariffs unconstitutional, prompting immediate replacement tariffs under different authority, while precious metals remained exempt under critical mineral classifications. Silver imports into the United States therefore avoid additional costs, removing supply headwinds and signaling government recognition of silver as a strategic material worth stockpiling. Project Vault, a $12 billion initiative, aims to build critical mineral reserves, explicitly including silver, reinforcing its role as a strategic industrial input. Simultaneously, China restricted silver exports through licensing, effectively prioritizing domestic industrial demand while removing majority refined supply from global markets. China controls up to 70% of global refining capacity, meaning export restrictions structurally remove large portions of refined silver from international trade flows. Shanghai premiums surged, with domestic silver trading far above Western spot prices, indicating constrained supply and strong demand within Chinese markets. China's solar, electronics, and electric vehicle industries continue expanding, ensuring domestic silver demand remains strong even as exports decline. While China restricts supply, India absorbs it, importing roughly 190 million ounces in 2025, representing approximately 1/4 of global supply. Indian imports surged 44% year over year, driven by renewable energy expansion and investment demand through exchange-traded funds and bullion accumulation. India's renewable targets require vast solar capacity, making silver essential, while potential import duty changes may create short-term volatility through accelerated purchasing ahead of policy deadlines. Global markets now face structural deficits, with cumulative shortfalls exceeding 800 million ounces since 2021, reflecting consumption exceeding production for multiple consecutive years. When major refiners restrict exports and large economies increase imports simultaneously, supply arithmetic becomes unavoidable. There is simply not enough metal to meet demand. During January's paper market crash, physical premiums surged above 50% as dealers refused to sell at futures prices disconnected from real-world acquisition costs. Exchange for physical spreads widened dramatically, lease rates surged, and mint production halted in some regions due to extreme borrowing costs for silver inventories. London Vault holdings appear large, yet much is locked in exchange-traded funds, leaving limited free float available to satisfy immediate physical demand. Liquidity stress events already occurred, including temporary market seizures, demonstrating fragility within the physical silver supply chain after years of structural deficits. ETF trading volumes reached records, with call options representing massive speculative interest, while mining equities remain undervalued relative to current silver price assumptions. Mining companies report record production and profits, yet analyst models still assume silver prices far below current levels, suggesting valuation gaps persist across the sector. Upcoming economic data, earnings reports, and labor statistics may influence sentiment, yet metals currently rally under both inflationary and disinflationary scenarios. The largest catalyst remains first notice day, where delivery math will reveal whether futures markets can reconcile obligations with available physical inventories. Federal Reserve leadership transitions, geopolitical tensions, and de-dollarization trends add uncertainty historically favorable to hard assets like gold and silver. However, risks remain, including liquidity volatility, managed exchange resolutions, extended timelines for bullish projections, premium compression, and potential industrial demand declines during recession. Markets are not straight lines. Incorrect long-term theses can still incur losses without proper risk management and realistic timing expectations. Taken together, silver's current structure reflects unprecedented volatility, tightening fundamentals, and systemic stress that will resolve through either price repricing or demand destruction. Verify the data, check primary sources, and understand this channel exists to provide transparent analysis so you can make informed decisions grounded in logic rather than hype.